I guess to begin with, let's begin with your overarching thesis on de-dollarization. Why do you think the world is de-dollarizing? How do you see it happening? And where do you see it going?
I think there's the reason the world's de-dollarizing is out of necessity. If they don't do it, if they don't de-dollarize, paradoxically, the dollar-centric system as it's been structured since 1971 and really since the early 80s will unwind, collapse. And paradoxically, that collapse will feature dollar up, not down. It'll feature rates up, not down, and it'll feature at first stocks down and then probably stocks up. But the reason this is happening is there's three very powerful forces that are buffeting the global economy. And these three things have never happened before in unison. First, you've got the first bursting global sovereign debt bubble in 100 years. And this time it's being led or centered in the West rather than in the emerging markets, as has always been the case over the last 40 to 60 years. Number two, you have peak cheap energy, peak cheap oil in particular, peak cheap commodities more broadly, which is not to say we are running out of commodities, but we are or have run out of the cheap stuff. And then the third key point is that something Jeff Booth has written a great book about, The Price of Tomorrow. Technology is imposing a non-linear deflationary force on a widening portion of the global economy. And that these three things, when you put them together, leads to a very difficult situation where the global sovereign debt bubble needs negative real rates, or else it will go into a debt spiral centered in the West. Dollar up, rates up, wash, rinse, repeat till the system comes unhinged. At the same time, the energy market, so you need high inflation relative to rates. You basically need significant continued negative real rates to prevent the global sovereign debt bubble from bursting chaotically. At the same time, you need high inflation in energy and commodities more broadly to incent the continued growth of commodity production to prevent shortages of those commodities, to provide the commodities you need to drive the growth, to support the economic growth, to support the debt. So the debt bubble needs low inflation, and the commodity situation needs high inflation. Those two things are fundamentally incompatible. And then layered on top of this, complicating things further, you have the inexorable and exponential deflation imposed by deflation, which also tugs on the debt because the debt needs some inflation, but not too much inflation, because the debt is so high that too high inflation makes the interest payments unaffordable to governments without printing the money. And technology is pushing it in the exact opposite direction. It's enforcing deflation. So you have these extremely powerful countervailing forces. And these are the three forces that are ultimately driving the de-dollarization of global commodity markets out of necessity, out of self-interest. China's not doing it necessarily because they want to. They're doing it because if they don't, their economy will collapse like Southeast Asia in the late 90s.
I see. So, I mean, I think this sounds pretty compelling on many levels. I think certainly the global sovereign debt bubble has been a big one. I think it's been many decades of, mainstream economists saying these things only happen in dysfunctional banana republics. They don't happen in rich countries that have rule of law, and basically white European countries and Japan don't get these things happen to them. They can just continue to borrow forever and ever and ever. And the last 2 years have been quite devastating for that thesis, because if you've held bonds over the last 2 years, I mean, it's just, to borrow a Michael Saylor phrase, it's all your models are completely destroyed. Everything that the post-world order has rested upon was the idea that you don't need to hold gold. Gold is a yellow pet rock. And in order to have a store of value, in order to have a hard asset, you just hold government bonds. That's the new gold. It's better than gold because it's connected to the global financial system. You can send it around, and as they famously used to say, you can't eat gold. Whereas, of course, as we know, government bonds are absolutely delicious and nutritious. And also, they offer you a yield, as all the people in the shitcoin industrial complex have found out. Just like sovereign debt investors, if you're getting a fixed yield, you are the yield. There's no yield. The notion that you're going to make positive real returns out of lending to governments that spend on all the crazy things that they spend money on and lock people up to try and fix the flu. If you fell for that, you might as well just fall for Luna and all these other yield scams that we've seen in the digital currency space. So that's clearly, I think, very compelling that there is a global sovereign debt collapse happening. And it's absolutely startling, and most people have no idea how to deal with it. I think the startling thing about it is the same people who said this thing could never happen are acting like it just doesn't happen. It's a very amazing, the Wile E. Coyote moment where he's hanging in the air and just about to fall, and he's just looking around in denial about the fact that he's going to fall. It hasn't sunk in yet. So I remember, very little coverage of the destruction of the value of bonds. Very little discussion of alternatives. And when you see people writing articles, I've seen several articles along these lines in the Financial Times and the Wall Street Journal, going along the lines of, well, this has been a horrendous crash for bonds, and if you're holding bonds, you probably shouldn't be looking at your portfolio too often, and you should probably be doubling down because we've hit the bottom and it can't get much worse than this. And it just keeps getting worse. It's for those of us who are familiar with the shitcoiners, this is classic shitcoiner cope. When say Luna, the algorithmic stablecoin, was crashing, you heard a lot of people saying, well, it's already down significantly, so now it's only up. Now is a great time to be buying. And a lot of people got ruined because they bought in the crash. And I think something similar seems to be happening with the digital, with the analog shitcoin space of sovereign debt, where perhaps it seems to me like this. I mean, if I were to make the kind of best case scenario, which you won't get bond bulls to say because it's not a very good scenario, but I think, if you wanted to say this isn't going to be tragic, well, we have a couple of more years of significantly high inflation in real terms, regardless of what the CPI shows. And then you devalue bonds in real terms. And so you raise government revenues because, when inflation goes up, government revenues go up. People are paying more, so people are earning more. They're earning more in nominal terms, but they're not earning more in real terms. So government revenues would go up, and then that allows them to pay off their old debt liabilities. And people who have debt, who have sovereign debt, will witness their bonds devalued in real terms, but they'll still get paid. And knowing bond investors, they'll still be happy about it and still be telling you that you can't eat gold. So don't you think that inflation can just fix this? More and more inflation, more and more devaluation of the currency, and therefore more and more easing the fiscal burden on governments. What exactly do you see as preventing there from being inflation? Why is this not a viable track for governments to take?
Well, it is a viable track in terms of inflating down debt to GDP. It is a viable track, and it's what the U.S. government and really all governments did after World War II, the last time global sovereign debt was as high as it is. And so in the United States, you had negative real rates of negative 13%, right? So inflation was 13 points higher than the yield you got on your bonds. And the U.S. was the winner that had no war damage. If you start going to the losers who had significant war damage, the real rates were a little bit more draconian. In Japan, they were negative 60%. Even in across Europe, Italy, negative 30, negative 40% is where real rates bottom. So you're losing somewhere between a third and 2/3 of your money in real terms in a year. And really most of your money in real terms over a span of several years. And that was how the world delevered. Thank you for your donation to the war effort. You're a patriotic citizen. Congratulations. And that is a viable track again. The challenge that it has been and remains is that once you get debt to GDP too high, so for the United States, 120% debt to GDP, you can't do modest doses of negative real rates over an extended period of time. That doesn't work because the amounts are just so great. And at some point, you start to see the debt to GDP stop going down and start going up again, which is precisely what has just happened in the United States. We peaked at 130% debt to GDP in the summer of 20. We got it all the way down to, I think, 118 or so, and it's bounced back up. It's now back over 120, just slightly. The issue is that the bigger the debt to GDP number and the bigger the twin deficits are, that need to be financing in terms of the current flow, not just the stock that needs to be devalued, but the current flow. And the United States is running deficits on the fiscal side of nearly 8%, or excuse me, over 8% on a trailing 12-month basis. What that tells you is you need really high negative real rates. And I did math back for our clients and report back in 1Q21. after the second or third or whatever it was stimmy package from the Biden administration, when it looked like this is what they were doing. And